Topic 7 focuses on ESG analysis, valuation, and integration within investment decision-making processes. The topic explains how environmental, social, and governance factors can influence financial performance, risk exposure, and long-term corporate value across industries and asset classes. ESG integration involves systematically incorporating sustainability-related information into traditional investment analysis rather than treating ESG as a separate or purely ethical consideration. The program emphasizes that effective ESG integration enhances investors' ability to identify material risks and opportunities that may not be fully reflected in conventional financial analysis, thereby supporting more informed and resilient investment decisions over the long term. A major topic covered in the topic is the distinction between qualitative and quantitative approaches to ESG analysis. Qualitative analysis focuses on evaluating factors such as corporate culture, governance quality, stakeholder relationships, sustainability strategy, and management credibility. Quantitative analysis involves the use of measurable ESG indicators, metrics, ratings, and scoring systems to assess sustainability performance. The program explains that both approaches are complementary because qualitative assessments often provide important context for interpreting quantitative data. Candidates learn that successful ESG integration requires combining financial expertise with sustainability analysis in order to evaluate how ESG factors may affect operational performance, profitability, and strategic positioning. The topic also examines the challenges associated with integrating ESG analysis into investment processes. One major challenge involves identifying which ESG issues are financially material for specific industries, companies, or regions. ESG risks can vary significantly depending on business models, regulatory environments, and stakeholder expectations. Another challenge is the inconsistency and limited comparability of ESG data across companies and reporting frameworks. The program explains that differences in methodologies, disclosure standards, and rating systems may lead to conflicting ESG assessments. Investors must therefore exercise professional judgment when evaluating sustainability information and avoid relying exclusively on third-party ESG scores or databases. Another important focus of Topic 7 is the development and use of ESG scorecards and analytical tools. Candidates study how investment firms create frameworks for evaluating sustainability performance across environmental, social, and governance categories. Scorecards may include metrics related to carbon emissions, labor practices, board independence, diversity, resource efficiency, or governance transparency. The program highlights that these tools help standardize ESG analysis and support more consistent investment decision-making. However, scorecards should be adapted to specific sectors and investment objectives because material ESG risks differ across industries. Effective ESG frameworks therefore require flexibility, industry expertise, and ongoing refinement as sustainability issues evolve. The topic further explores how ESG analysis complements traditional financial analysis and valuation techniques. Candidates learn that ESG factors can influence revenue growth, operating costs, capital expenditures, regulatory exposure, brand value, and cost of capital. For example, strong environmental management may reduce regulatory penalties and operational inefficiencies, while effective governance can improve strategic oversight and investor confidence. The program explains how ESG considerations can be incorporated into cash flow projections, discount rates, scenario analysis, and credit assessments. By integrating sustainability information into valuation models, investors gain a more comprehensive understanding of long-term risks and value drivers affecting investment opportunities. A significant section of the topic focuses on how ESG factors influence company and industry performance across multiple asset classes. Environmental risks may affect energy-intensive industries through carbon regulation or resource scarcity, while social issues such as labor relations or consumer protection can influence operational stability and reputation. Governance weaknesses may increase the likelihood of fraud, litigation, or strategic failures. The program demonstrates that ESG risks and opportunities are relevant not only to equities but also to fixed income, private markets, infrastructure, and alternative investments. Integrating ESG analysis across asset classes enables investors to improve portfolio resilience and align investments with long-term sustainability trends. The program also addresses ESG data sources, databases, and rating providers commonly used within the investment industry. Candidates learn about primary sources such as corporate sustainability reports, regulatory filings, and company disclosures, as well as secondary sources including ESG research firms, data vendors, and rating agencies. The topic explains that ESG databases and screening tools help investors identify sustainability risks, benchmark performance, and conduct comparative analysis. However, ESG data providers may use different methodologies, weighting systems, and assumptions, leading to inconsistencies across ratings. Investors must therefore critically evaluate ESG information and understand the limitations of external data sources and analytical platforms. Overall, Topic 7 demonstrates that ESG analysis and integration are essential components of modern investment management and financial analysis. The program emphasizes that sustainability factors increasingly influence corporate performance, regulatory developments, investor behavior, and market dynamics globally. By integrating ESG considerations into valuation models, risk assessments, and portfolio construction processes, investment professionals can improve decision-making quality and identify long-term opportunities more effectively. The topic ultimately reinforces that ESG integration is not a replacement for traditional financial analysis, but an enhancement that provides a broader and more forward-looking understanding of investment risks, sustainability challenges, and drivers of long-term value creation.